Fibonacci, right? Going from the March 2020 bottom to the November 2021 high. And this seems to be tracking really well. You can see it on the weekly chart decently, right? You can see Bitcoin holding above that inverse 618 pretty clearly, right? And you see it all the way back to January 2021. You see it in the summer of 2021 as well. And you see it in May of 2022. You see that this inverse 618 has been in a very, very relevant level for Bitcoin over the past literally now 3 years. And if we look at it on the daily chart, we start to see that Bitcoin is now consolidating at what looks to be a higher low, right? We got the series of higher highs and higher lows. You can see it very clearly on the daily chart. It's no coincidence that higher low is forming right atop the inverse 618, right? So this inverse 618 is huge. I'm starting to suspect that the next move we're going to see is going to be a big one, like bigger than this one. Bigger than this one. You know, the kind of move that makes people turn their heads and start thinking like, oh man, maybe I should be in Bitcoin. You know what I mean? Because right now, even though we've had this uptrend, right? We've had this very clear uptrend since November of 2022, right? People still aren't really bullish on the markets. Like nobody is bullish on the markets. It's crazy. Like, literally, I'm talking, you know, I'll just name a few names, but like one of the classic technical traders that everyone knows on YouTube, Gareth Soloway, right? This guy has been bearish the whole way up. The whole way up, he's been bearish here. He's never turned bullish. And to me, that is the sign of a strong uptrend. And it's also a sign that we're early in the uptrend. No one believes it yet. Like, no one believes it. And I'm singling out Gareth Soloway, but it's like, you name it. You go and look at technical analysis on YouTube right now, and it's just everyone is bearish, even though, look at the freaking chart. Does it look bearish to you? No, it especially looks bullish when you look at the S&P 500 against a Fibonacci, you know, in this local structure that goes back to January 2022. It's like, okay, you've closed weekly candles above the 786. Finally, you're getting a pullback. Finally, right? But think about this, right? If you're a technical trader and you are just now shorting the market after this after this pullback here, don't you feel like an idiot, right? I mean, that's like the classic bear trap, right? And I could be proven wrong. But to me, this is just a pullback within an uptrend, and it's also a bear trap because everyone is looking at this market with a bearish bias, right? So they finally see a little bit of weakness. They all jump on the bear train. They're like, here it comes. Here we go. Crash. We've made it. Finally, the crash we've been waiting for all this time. It's here, right? And it's like probably just a pullback within an uptrend, right? I mean, that's how trends work. They have higher highs and higher lows. We're very likely forming a higher low at this point, you know? Now, one thing I want to explain here is just this phenomenon that we've talked about so much, the idea that the market makes as many people look foolish as possible as much of the time as possible, right? So that's why you have YouTube technical traders being bearish throughout this entire uptrend. This is a phenomenon. It's the oldest phenomenon in financial markets. You know, it goes back hundreds of years. The majority of people are on the wrong side of the trade. Now, I've talked about the mechanism by which that happens, but I'm just going to briefly bring it up one more time, right? It has everything to do with the options market, right? Because remember, the market is run by brokers, right? The brokers, the ones who are selling you equities, the ones who are making money on every transaction, buy or sell, right? The brokers run this market, okay? Now, how do the brokers make the most money possible? Well, it's through the options contract market, right? So the brokers have market makers working for them, okay? Market makers write put options and call options, right? They create options contracts, put options and call options, right? So what they want to do is sell those option contracts to people only to then buy those option contracts back from the people they sold them to at a lower price than they were sold originally, right? So let's just say one set of call options is worth $100, right? So the market maker sells the call options at $100, right? They want to buy those call options back at any price less than $100. So what will they do? They will do whatever they can to move the market in the direction that will devalue those contracts, right? So this is how people get on the wrong side of the trade. It's because you're literally working against the market maker. The market maker's profit is your loss. And this has always been the way. It's always been this way in markets. And this explains why most people are on the wrong side of the trade. It's because the market makers who have the most capital, who can move the markets, are moving the markets in such a way that they are devaluing the holdings of market participants, because that devaluation is the profit to the market maker. So as it applies to the current scenario we're in here, right? All the technical traders are bearish, right? Because of the bearish economic nightmares afoot, right? At any moment, we're going to have the Great Depression round 2, right? That's what everyone's thinking, right? But look at the market. It keeps rising. So what's going on here is people, the majority of people, are buying put options. They are buying bearish option contracts, right? So the market maker's way to make profit here is to keep sending the market higher. All of those put options expire worthless, which is like, that's like the grand prize for the market maker. Or the people capitulate on those put options and they sell them back to the market maker at a way lower price than the market maker sold them in the first place, right? Like, option contracts are particularly volatile. So if you're buying a set of, like, let's say all the people who bought put options right here, right? They were at the 702, right? S&P's at the 702. Technical traders are like, okay, 702 reversal, here it comes, load up on the put options, right? They buy like $10,000 worth of put options right here at the 702. The market maker sends the market higher, and those people who bought $10,000 worth of put options right there are forced to sell those back to the market maker for literally $3,000 or $2,000, right? Options are extremely volatile. So this is an extremely profitable way for the market maker to make money. It's also extremely profitable for the market participants if you're on the right side of the trade. And as I've said, this was the best buying opportunity of 2023, right? The back test of the almighty trend line, right? So if you were buying call options, if you were bullish after this back test, you made a sick amount of money, a freaking sick amount of money, because of the volatility of options, right? They appreciate rapidly, but they also depreciate rapidly if you're on the wrong side of the trade. Most people on the wrong side of the trade all through here because they're looking at economic data, right? They're trying to make sense of this uptrend in the context of, a horrific economic landscape, right? Now, the credit rating for the U.S. has gone down, all this stuff. I don't even need to list all the things, right? The only thing that matters is the chart. The only thing that matters is the trend. It's going up, right? On a weekly basis, this market is in an uptrend. It's undeniable. Now, in a macro basis, like if you go, if you consider it on a yearly basis, it's hard not to see this October low as a higher low, right? It's just a higher low because where was the low before it? It was way lower, right? So you have the series of higher highs and higher lows. And I've been talking about this for literally, this goes back to early white knuckle stuff. It's like, in the macro sense, you cannot make a case for anything other than an uptrend, right? You just have higher highs and higher lows, right? You had the higher low of October 2022 relative to the low of March 2020. It's impossible to see that as anything other than a series of higher highs and higher lows. So the next logical step in the uptrend would be that you do break the all-time high. And when you're considering that you've broken through all retracement levels, you've closed a weekly candle above the 786, it's like you kind of have to be dumb to be bearish right now. Now, I'll caveat that by saying, if you're looking at the economic data and you're buying put options, you're not necessarily dumb, you're just a logical person, but you don't understand how markets work, right? You don't understand that markets can continue to rise no matter how bad, the economic data is, right? So when I say you have to be dumb to be bearish against this market, I just mean relative to the chart, relative to the uptrend that's right in front of our face, right? You have to be dumb not to see this uptrend. It's crystal clear, right? Okay, so with all that said, let's just take a look at the DXY, because this, once again, it's like literally speaking to us, right? We said this blue trend line that is now intersecting with the inverse 0.5 Fibonacci level is continuing to be resistance, right? Price could not close a weekly candle above. It poked above, right? But all that downward pressure showed up right on schedule to keep price closing below that crucial trend line that we've been tracking, right? Look at this thing. So this is confirmation that the DXY is weak. It's in a very, very clearly defined downtrend, a very, very clearly defined series of lower lows and lower highs, and you're also closing candles below very, very important levels. So there's really no expectation that the dollar can recover from here, right? It's more likely going to continue in its downtrend, which corroborates the continuation of the S&P 500, the broader stock market, in this uptrend, right? Okay, last thing I want to say on this white knuckle report here. Now, we've talked about this, like all the stuff I've been talking about in white knuckle since the beginning is full circling here, right? So I've talked about the idea that, as we go farther forward in the future, more of the wealth gets concentrated into a smaller group of people, right? So really, really good example of this is this clip that came out just a few days ago, or one day ago, right? This clip, right? This is from 2016, right? Okay. This is Patrick Bett talking about BlackRock, right? So this is a really crucial point that he makes. I'm just using this as the source of the statistic that I'm going to use right now, because I don't want to say this statistic without providing the source, because it's a pretty staggering statistic. So in this very clip here, this guy, Patrick Bett, makes the statement that, and this is 2016, he's saying that in 2016, BlackRock, Larry Fink, that whole group, right? They own 88% of the S&P 500, right? They own 88% of the equity in the S&P 500, right? So this corroborates the idea that as we go farther forward in time, the wealth gets centralized, right? It gets held by an increasingly smaller group of individuals the farther we go forward in time. That's just a result of late-stage capitalism that's baked in the cake. It's nothing new. It's nothing complicated. It's not esoteric. It's basic. But what is the result of that? Okay, the result of that is that the things that used to manipulate supply and demand, aka the Federal Reserve, interest rates, things like that, they do not work the way that they used to work, right? If a single entity holds 88% of the equity of the broader stock market, do you think that raising interest rates are going to cool off demand? No. Absolutely not. And this is proof of that. And we've looked at the charts, and we've looked at since 2001, interest rates have never cooled off the economy. The very beginning of an interest rate cycle causes a pullback, but then as interest rates continue to rise, the market continues to rise. That's because the Fed raising interest rates is a reaction to an increase in demand that outpaces supply. But what is the actual reason that demand continues to outpace supply? Because supply is hoarded by like one group of people, right? By two or three groups of people at the most. Basically BlackRock, basically State Street, basically Vanguard. They hold all the equity, or at least 88% of the equity. So when that's the case, demand will always continue to outpace supply because supply is locked up. That's how you explain this market moving up as the Fed continues to raise interest rates. It's just everything is corroborated, okay? Do you understand this? You have to understand this because that's how you can sort of bet that this market is likely to go all-time highs right here. That's how you can bet that this back test of the almighty trend line was the best buying opportunity of 2023, right? It's because right now we're in a situation where the majority of Americans are not participating in this part of the economy, right? The majority of Americans are not using the stock market to grow their wealth, right? Maybe they have a retirement account, but they're not actively using it, right? They're just They're just quote unquote buying the dip. And guess what? That's actually not a bad idea, right? Because if you did buy the dip in your retirement account, well, you look like a freaking genius right now, right? But at the same time, none of those people were selling up here. So, and they're probably not going to sell when the crash comes, right? They're all exit liquidity, right? All the people who have retirement accounts who aren't actively monitoring those accounts, they're going to be the exit liquidity when BlackRock dumps up here at the 1618. You see what I'm saying? But the point that I'm trying to make is that you can't expect anything that the Federal Reserve does to impact supply and demand because the supply is locked up by a small group of individuals, and the dollars chasing that supply will continue to outpace that supply because the Fed, the Treasury, the United States has completely normalized printing money. So the more dollars that are out there, the more dollars chasing that supply, that's only going to send price higher and higher. That's exactly what we're seeing, even though interest rates are at 20-year highs, okay? This is nothing new. We are not surprised. We have been talking about this in the White Knuckle Report for literally a year, at least a year. I've been predicting this exact scenario. It's like interest rates are going to rise. They're going to go super, super high. But the stock market will rise the whole freaking time. That's exactly what's going on here. You better believe this market is going to go to new all-time highs. And you better believe that in that time, crypto is probably going to outperform it, right? It's probably going to do what it always does. In this setup, it's like, look at this. Come on, look at this on the daily chart. Are you not kind of licking your lips right there? It's just like perfect consolidation above that inverse 618. It's like above the important moving averages, above the 200 period moving average. That's the important one. It's like this thing is probably consolidating for another move to the upside. And I would expect that to be on the explosive side, considering what the DXY is doing. This thing is about to puke downwards. It's getting sucked into the inverse 702. So that's what I got for you.